Oh, good afternoon, everyone. So I'm going to do a little bit on the Schroder multi-manager range, but I want to spend most of the time just talking about some of the worries that we have for investing and how these may impact you and your clients as we go forward into what has already been a pretty decent bull market. So on the screen now, I'm going to start showing you some valuation things just to try and get some basic ideas across. Now, there's two charts on here. The one on the left is showing you the price earnings relative between the US market and the European market. So effectively, when that blue line is going up, that is the US equity market becoming more expensive relative to the European market. Now, if you go back to the early days of this chart, back in 1979, Europe, started out performing really well. The blue line was going down. Europe became pretty expensive, got to -20. And then, as always happens, there's a bit of a swing back in markets. The blue line starts going up. That's America becoming expensive. And it goes to around about 50. Then it bobbles along a little bit. And today, we're at around about 80. So our interpretation of this is that the US equity market is fantastic, but everybody knows it. And it's already very, very expensive relative to history and relative to other opportunities out there. The European equity market for us still represents good relative value, but I'm afraid the bull market now is 60 years long, so we can't even say that the European market in itself is cheap. All we can now say is that it's cheaper. The graph on the right-hand side, as you're looking at it, is the PE relative of the Eurozone periphery relative to other European equities. And the point we're trying to make here is that actually the cheap bit of the cheap market, Europe, is the stuff that we're all a bit scared of. Ireland, Greece, Spain, Italy. And actually that kind of makes sense. That's why it is cheap. It's the place where the problems have been. It's the bit that got held back. It's the bit where international investors have been very, very worried about investing. So if you do believe in what we're saying here, which is that the US is expensive, maybe take a step aside from the US equity market. If you believe that Europe is cheap, absolutely. But don't then go and make the mistake of buying safe Europe, because actually that's at pretty high multiples as well. The US equity market has been just an outstanding return area. It was something that we were overweight for 4 years, but for the last 2 years, I have to say, we've actually missed out on some of this. The orange line here is the S&P 500. It's not actually labeled on that chart that I can see. And the blue line is the MSCI World excluding the US. And again, if you go to the beginning of that chart, the relationship between the blue line and the orange line is actually pretty tight. They're pretty highly correlated. Then the financial crisis happens, they both go down together, and then the recovery comes, but look at the orange line. It really does take off around about 2012, whilst the blue line does okay, actually, in fairness, but the orange line is completely the star. Now, if you go back to 2007, I think we'd have all probably been told that the US economy was very mature, pretty dull. Why on earth would you invest in the US? It's all about emerging markets. Demographics are on their side. They don't have any debt. They've got all the resources. It's all fantastic. I mean, at the moment, it feels like that's completely flipped on its head. Everyone loves the US. The valuation is incredibly high. And emerging markets, well, that story appears to be over in a lot of investors' view. I'm not sure that's necessarily true. So why is it that the US has tended to do so well? Well, in terms of earnings, well, the forward earnings, which is the orange line on this chart here, it has been fantastic. You have invested in the US equity market. US shares have done well. They have produced the profits, and therefore the share prices have gone up. The blue line, which is the forward earnings per share forecast for the Eurozone, well, it's been pretty dull. And that's why Europe has been held back in terms of stock market returns. We believe that the Eurozone problems have been the major reason for that. And now that Mr. Draghi has launched his QE program, I think that's incredibly significant. And actually, we're starting to see forecasts that were for negative growth this year for Europe, actually now forecasting positive growth. So we think that whilst the expectations for America are incredibly high at a time when the US stock market is also very high, it's still only around about 4% of a new all-time high, despite all the volatility of August. Europe has very little expectations, and as I said earlier, is probably relatively cheap. There are cyclical differences. America's far further through their economic recovery than Europe is. And the chart here, you watch out for the orange line here. This is the unemployment rate, and it looks like I'm telling you that unemployment is going up. We've inverted the axis on the left-hand side. We're just trying to show the relationship between the two series. The blue line here is wage growth in America. So the story of this recovery is that it's been a recovery. It's been okay. It's just been pretty dull, actually, in terms of recovery. Unemployment hasn't really improved, and there's no wage growth. Well, I'm afraid this chart suggests completely the opposite. So when the orange line is going up, this is unemployment falling. The latest release was that unemployment in America is now 5.1%, which is bang in the middle of the Federal Reserve's own definition of full employment. They said 5 to 5.2, and it came out at 5.1. Why is that important? Well, we're going to find out tonight if it's important or not. In terms of wage growth, I like this chart because it shows the correlation. As more people become employed, there is less unemployed people, or reserve army of labour, as they say in economics. So therefore, employers have to pay more money to get skilled people to go to work. And what we're seeing is that wage growth is really picking up quite nicely. So not only have we got a fairly good economic recovery in the US, we're getting good wage growth, more people in work. This should be a self-sustaining recovery. Not brilliant, but self-sustaining. And that's why I think they should have raised rates easily over a year ago. I suspect just to spite me, they won't do it tonight. But they really should be getting on with it. And I'm a bit bored of talking about it, so it'd be nice if they just got it done, really. Fixed income, which is everyone's favourite subject. Now, this is the warning that I think is the most relevant to everyone. When we deal with clients and we're talking about creating cautious portfolios, normally the bedrock of everyone's cautious portfolio are bonds. And it's a good reason. They've done very, very well over time. And in fact, if you look at this chart, going back from 1989, the yield that you used to get on a 10-year government bond, lending to the government for 10 years, was in excess of 12% at one point. Fabulous return. Now, inflation was very high, so the real return was still pretty good, but it was nonetheless 12%. Today, that number is 1.8. And if you know anything about bond maths, as the price of a bond goes up, the yield goes down. So that means with very low yields, the prices of bonds are very high. Now, I would argue that if you looked at today's pricing of a 10-year government bond, it's basically telling you that there's a recession around the corner. And all the data we're looking at is not telling us that at all. So we think that quantitative easing programs in the UK, the US, to an extent Japan, and more recently Europe, they've suppressed yields. They've printed money, gone into all these financial assets, brought those yields down. So even though you can be fairly happy about a UK recovery and a US recovery, the prices you're being asked to pay for this now are too low. Now, why is that a problem? Well, if we were to go back to a yield that was acceptable to investors at the depths of the financial crisis back in 2008, that was a proper panic, and people were buying gilts because they thought banks were going to go bust. Okay, it was a place to hide your money for a little while. That was seen at the time as being a very, very low yield, 3.3. But if we were to go back to that yield from 1.8, the capital loss on that bond is 11%. Okay, you haven't gone to war. There's no sterling crisis. Corbyn's not in power. We haven't left Europe. All that's happened is you've got a bit more optimistic about the UK recovery, and investors have realised that inflation's more likely to be 2 to 3 than where it is at the moment, which is around about 1.5. You're getting no real return. Now, if we were to go back to the long-term average yield on a 10-year gilt, 5.5% yield, that is, that would actually induce a 25% decrease in the capital value of your bond. Okay? Pardon me?
I said this is low risk stuff.
This is super low risk.
Super low
Risk. What could go wrong? And again, it's not like the UK government's gone bust or anything. All that's happened is you've got a decent recovery, and we're going back to sort of normal economics. Yet this, under most stochastic models, is the safest asset and will probably form something like 50 to 60% of your client's assets. And I'm just not sure that's right. Back in 1989, yielding 12, absolutely, I can see that. Particularly when you had an independent central bank that came in with a mandate to get growth at a reasonable level, but also to really contain inflation. I mean, that war has really been won, although Mr. Corbyn may try to backtrack that at some point. Fixed interest remains very vulnerable. It really does. This is interest coverage within high-yield energy, and what we're basically showing you here is that there's an awful lot of leverage within fracking companies in America, and they don't seem to have the cash flow currently. So watch out. It's not just government, it could be corporate as well that's getting it overdone. The quality of the bonds that are being issued, if I lend to someone, I ensure that I have insurance within the covenants of that bond. In other words, I get my money back. Companies issuing bonds at the moment are able to put in very, very light covenants. Cov-light, they're known. In other words, bondholders are now willing to take less protection at a time when these things are very expensive. So the Cov-light issuance is going up. This is the sort of thing that presaged the 2008 financial crisis. And liquidity, if I really want to ram this home. Liquidity in the bond market's gone down. The green line here are the dealer inventories that the banks used to have, but of course then the regulator came in and said, that's a bit too risky, you shouldn't be doing that. So the green line's been going down and down and down, and these are the guys that provided liquidity to the bond market. Meanwhile, the blue line has gone up and up and up, which is the amount of corporate debt outstanding. So a conclusion that could be drawn from this is that as the market's got bigger and bigger, it has actually become more illiquid. Now, every fund manager, I'm a fund of funds guy, as you probably know, every bond fund manager I talk to says, look, this really isn't a problem. We can get liquidity when we need it. Well, maybe, but every crisis normally sees liquidity dry up, and it's already pretty low as far as we're aware. So the risk there, I think, is completely underappreciated. People have said to us, well, why on earth, what's your response to it? And we said, well, if we think something's expensive, and we're trying to give a cautious return, because a lot of our funds are used in pension products and so forth, then actually we need to sidestep that risk and hold a lot of cash, which is what we've been doing for the best part of 18 months. Now, for the first 6 months of that, it was horribly wrong, as bonds continue to do well. But for the last year or so, it has actually started working. But the most often response we get is, well, why don't you own these bonds right up until the point that they go really badly wrong, and then you can sell them? And it is a bit like picking up pennies in front of a steamroller, that sort of theory. I just don't think we should be trying to do that. The other thing is that we think that portfolio diversification is actually going down. Correlations do change over time. And this chart here shows you, not very clearly I'm afraid, the blue line is global bonds, the orange line is property, the greyish line is the MSCI World, and the green line is commodities. Now, what we've all been brought up to believe under modern portfolio theory is that if you spread your assets, that when one thing's going down, another thing will be going up. The point I'd like to make is as that grey line's been going down, so's the blue line, bonds, so's the orange line, property, and look what commodities have done. So I do think that actually if you're thinking about diversification of your clients' assets today, you may need to behave in a slightly different way to what you were doing 5 or even 10 years ago. Alternatives is one of our approaches to getting into this, and we don't mean just anything that says it's not a bond or an equity. Property, for instance, is always trotted out as an alternative. I just don't think it is. It's been fantastic for the last couple of years, but I do wonder if it can really keep it up. We want things like hedge fund strategies, maybe some currency positions. We could use things like private equity, but to be frank, it's too illiquid for us to be able to use it. So alternative methods of diversification are needed. Most funds are sort of 46% bonds and cash, 44% in equity and 10% in something else. Diversity is a third. It's properly diversified all the way through an economic cycle. It's what differentiates it. It's only trying to do CPI plus 4. We're not trying to do 100% a year, which means that hopefully we won't give you minus 50% either. The sort of things that we're currently looking at, which I heartily recommend to you to then go away and look at yourselves actually. These are all open-ended daily dealing funds that are available to buy apart from Tortoise, which is currently closed. Majedi Tortoise, the top left here, it's an international equity long-short fund. It can prosper when things start going down, which inevitably they will do. It has a very low net. In other words, the performance will not be driven by the returns on the stock market, be driven by the returns within the stock market. So you could go long pharmaceutical, short mining, for instance, as an idea. Artemis Strategic Assets, very much in line with our theme that bonds are looking pretty expensive, that could easily walk into a bit of a bear trap at some point. William Littlewood, who's made his reputation back in 2000 for running the Jupiter Income Fund, is now at Artemis running a multi-asset fund where he is actually short bonds. In other words, if our worries about the bond market come to pass, he can actually make money out of it. And then 2 other long-short funds which we own, we invest in, and I recommend you look at if you do get some time. In terms of team and process, I don't think we want to go through that today. So in summary, what is it that we're currently doing in our portfolios, and maybe a challenge to what it is that you're doing in your own? Currently, cash is very high. Now, when you look at that in its own right, diversity, for instance, which should be a third in fixed income and cash, it's around about 30% currently in cash, because we're so worried about what could happen in fixed income world. That means that we do not like corporate debt or government debt, and we have used that cash to tactically put positions in the US dollar, which actually we sold out of in April because the dollar was basically consensus long by everyone, and we made decent money out of that. In alternatives, absolute equity and absolute macro, these are our favorite genuine alternatives. And what we need from these things is that if our views about some of these markets come to pass, that they're able to make some money in difficult times, rather than just avoiding losses, actually make some money. Which is fully in the spirit of trying to be a multi-asset guy. Property is a very unpopular underweight for us, /0 holding. It's normally the thing I get most challenged on, actually. But it's basically property, I believe, has benefited from 30 years of falling interest rates. And with rates at 0.5, I just think it may be constrained from here. And in equities, Japan and Europe, definitely our favoured areas. They're relatively cheap. They're not absolutely cheap. But we do think there's very little expectations from those markets, and therefore you can make a bit of money. The US, I think, is an absolutely awesome stock market. It's just too expensive now. And emerging markets, well, we've actually just started putting in very, very small positions into the portfolios to reflect that actually some markets have been absolutely hammered, not only from an equity standpoint, but also the currency. Now, we're not actually saying to anyone, this is the best idea we've ever had, you ought to do this as well. But when something's fallen 30, 40%, maybe it's worth having a nibble. And so we've put in 0.5% positions just to get a start. Well, ladies and gentlemen, thank you very much for your attention. And I think I'm going to stay here.
Sit down, Marcus.
Okay. Thank you very much. Thank you.